Hello, ladies and gentlemen. Welcome back to the channel. I wanted to first thank everybody for liking the videos, commenting, subscribing. You guys are awesome. Some really good discussion on this channel. Now, first things first, this video is going to cover the GameStop warrants, why I believe they're up 60% off their lows. There are 3 or 4 critical things to know about these. And then Michael Burry and share buyback discussion will be at the tail end of this video, a little tinfoil sprinkled in at the end. And before we dive in, I wanted to say this is not financial advice. Anything I say in this video should not be deemed as such, and I am not a licensed financial advisor. With that underway, or excuse me, with that out of the way and understood, let's dive into why the warrants are up 60%. First things first, go GameStop warrants. This is awesome to see. I think for any holder that has been a little bit mixed on the dilution and the different forms of that GameStop Corporation have done over the last couple of years. I think this is a really nice way to reward shareholders while also benefiting the company. Now, why are they up 60% off the lows and in a very short amount of time? So you can see the current move is 50, but if you measure to the top, it's upwards of close to 60%, which is an incredibly strong move, really, in 1, 2, 3, 4, 5, 6 trading days. Okay, so just over a week. Now, GameStop, the underlying in that same span, let's measure that move, is up a modest 15-ish percent to the top of the candle wick. So obviously the warrants are moving quickly and they're moving in a way that the stock really isn't. Yes, they're both going up, but the warrants are going up much faster. Why is that? Well, if you want to know the inner workings of these financial products, I'm going to turn your attention to a super stonk post from Bob Smith. If you don't know who this is, if you're not in the DD community, Bob Smith has been a really good writer on mainly derivative products over the last few years. Really good options knowledge. It kind of reminds me of the Roaring Kitty meme where he said options 101. This is basically who Bob Smith is in a nutshell. But let's dive in and kind of go over the layman's terms of why the GameStop warrants are moving so quickly. So he goes on to mention some high frequency algo trading, which is nothing new here. But this is the last sentence here. One new player entered, and suddenly you had both camps running the same play. Long the bonds, the GameStop bonds, short the stock, delta hedging. That created a massive synthetic short position on GME. Now, of course, we know and think that over the last however many years and change, the reported short interest is probably very low in terms of what the actual synthetic position is against the underlying stock. But this might explain really the mechanism and the mechanics of why the warrants are so quick to move. Now, he's saying this matters because it limits the supply of shortable shares, which is good. It drives up short interest rates and creates liquidity issues in the lending pools. All these three things, in my opinion, are a net positive effect for the underlying stock. So he's basically saying we've got a recipe for a violent covering event. When it breaks, it's going to break fast. Now, I would just caution that, and you know how bullish I am. I would just caution that thinking in those terms needs just a little tempering of expectations. And I'm not saying there's not going to be a squeeze or this and that. I don't know. I know nothing. I can't make that more clear. But I would just say, the upward price action is nice, but the reality is when GameStop gets over $32 a share, these warrants will be incredibly valuable. We're talking significant value because that's the right to buy GameStop at $32 a share. But if they're exercised and if there's a short hedge fund or someone that wants to exercise to get shares of GameStop back in return, that will be a dilutive aspect against the underlying stock, which is critical to know. So yes, I think these warrants are going to go very high, and this is not financial advice, but it's because I believe in the underlying business, by the way. But shorts can use that later on down the road as ammunition as well to dilute the stock. So I really wanted to hammer home that point because this is inherently bullish. This is inherently good for the company. And if we look, I'll pull up an example later on of Occidental Petroleum who did something similar. You'll see why the warrants look incredibly bullish and really good for the business. So essentially the fundamentals have completely changed. If you're new to this channel, you'll know that I every single video I say 5 profitable quarters in a row. Why do I keep saying that? Because Ryan Cohen has truly, truly, truly flipped this business around and has made it a cash cow and into really what a stronghold company should look like. Now, basically trajectory, 500 million a year profit is within reach. Outstanding shares are 447 million, with fully diluted bonds and warrants is 590 million. That's why there were 59 million warrants issued. So institutions seem billions in free 0.0 coupons. It's not a coincidence. It's confidence. I like the writing style here, but essentially, real quick on the recap, for every 10 shares that you hold, you get 1 warrant. The strike is 32, and they currently expire in October of 2026. Now, it's very important to also know that the company can change this expiration date. They can extend it. So while that's set for stone right now, October 26, they can chisel away and extend it if they so choose. Do I think they're going to do that? It's far too early to say that. So where's the mechanism? Why are they going up so quickly? Well, every single short borrower now owes a warrant. So you know that the borrowing shares and the synthetics that they do that, they might not all actually exist, but the warrants, there's only a finite amount. So you need, if you short the stock and you also need a warrant in return, you have to go and buy that warrant. Every short seller is a future buyer. In this case, they literally have to buy the warrants. So 14.2 million warrants are straight from the bondholders. So everyone flipping the 2030 notes and the 2032 converts, every single one of those will need warrants. That's 25% of the total warrants in existence for GMEWS, which is the ticker. That in and of itself, 15% to bondholders is incredible. Why do I say that? Because of delta hedging. We're going to get to that in a minute. So on paper, that supplies them, but here's the kicker. These guys are the ARBs. They're already running delta neutral hedges. Now they suddenly hold 14 million new long delta instruments. So essentially they are long on paper with the warrants. What do they want to do in turn? Well, to remain delta neutral, they want to short the stock. So what did we have right here, right after warrant issuance or the delivery date? Well, a straight shot down to the tune of 26 to 27%, really upwards of 30 if you take the wick to wick. Incredible. So in this time, they are shorting the stock. There's probably 2 or 3 swap rolls in here as well. It's perfectly coincidental timing. And that's why I further to the point where I think, moreover, Ryan Cohen knows exactly where these swaps are throughout this period. When I say exactly, I mean a good general understanding that in this year, in years past, in this month, there have been other swap rolls as well. Why not take advantage of that? So what do? They short the underlying. They remain delta neutral by doing this. And in the same span, they short the warrants, but they are owed and they have to buy. So a very interesting mechanism here. And again, I don't want to see anyone fall victim to the mindset that, oh, hey, someone sitting at their desk in their underwear bought, 1 million warrants and now they're up 60%. That's not how this works. And I'll show you that on the order flow. This is the order flow of the warrants from December 1st when they put in one of their biggest day really yet, up 21%. This is what the order book looks like. There's nothing here. There's nothing of interest. 5,000 blocks, a bunch of these. These are probably bond desks. These are probably the bond sizes, automatic trigger for buys and sells when they're delta hedging their bonds. That's probably what that is. But this is not something that's going to set off some sort of short squeeze just on volume alone. So let's keep reading here. Bondholders receive the warrants. They gain long delta, but they must short GME. Non-bond shorts and derivative shorts and borrowers still owe warrants, forcing them to buy them in the open market to settle their obligations. So they're like, oh my gosh, we have obligations here that are due, and I'll show you the exact settlement dates that corroborate this perfectly. Oh, we got to start punching in orders. Punch in orders. Boom. Ignite the fire, 60% up in a matter of basically a week. Okay, so delta neutral, my butt. Bond arbs want to stay delta neutral, but warrants equal extra long delta. To stay neutral, they've got to subtract delta by selling shares the same way they've always done it. Essentially, and I will start to summarize this for you, this whole time, they are selling underlying shares. In this little upward pressure here, why is GameStop only up 15%? To remain delta neutral for anyone buying warrants, they want to sell shares as well, whether it's synthetic or real. You be the judge, you be the commenter in the comments below. Let me know what you think. But very interesting mechanism. Now, this is scarcity as well. Why? Because warrants are the linchpin. Shorts who borrowed shares must deliver on the warrants. Bond arbs who shorted the stock must deliver on the warrants. Essentially, this is a hot potato type situation where you have hedge fund A passing the bag to hedge fund B. But at the end of the day, who's ever shorting the stock, they still need to deliver a very finite 59 million amount of those warrants. So market makers are short gamma from day one. They buy into strength and sell into weakness. Add in the bond arbs to stay neutral, and you've got a constant volatility feedback loop. So you're going to see downward pressure, but the upward pressure, I would wager, is going to be just as violent to the upside. And that is, again, not financial advice. This is just the mechanism that Ryan Cohen has created with the bond offerings and now the warrants. You're going to have swings up and down. And I would say to anyone watching these videos, this last month and change of price action has been horrible. And we're still trading at $22.70. I mean, that's not a price that I think GameStop is valued at. I think it's significantly higher than that, in my opinion. Let me know if you agree. So, point being, the warrants, let's not get too excited. Let's not have FOMO here. Let's watch the mechanism unfurl as shorts scramble in the background to satisfy obligations. Now, that is the essence of what's going on. Delta neutral strategy. If you're not aware of these terms, you effectively want to remain almost equal weight long and short. You'll take advantage of the little pops long. You'll take advantage of the pullbacks short. You want to remain almost neutral on the equity. So you can read more about this, read about it with options, derivative products. The warrants in this case, I think there's a really good comparable example to Occidental Petroleum. I'll pull that up now. In the black part of this graph, these are the warrants. You can see when they were introduced, Oxy was at a pretty much rock bottom lows. The warrants come in and they basically squeeze. And why do they squeeze? Because the underlying stock had a massive run up as well. The difference here, and there's really no apples to apples comparison. So I would caution anyone looking at this graph and saying, oh my gosh, the GME warrants are going to go 1,000%. They could. I mean, I could see that, right? The only thing here is, though, that the company needs to take advantage of these moves as well. Ryan Cohen, if this is going to be the case, and Oxy, by the way, I think these were much longer dated than GMEs. These are up until 2030. They were issued in 2022. They have longer term, longer theta. So, this is going to be a little bit different of a situation, and the strike was 22 on these. So, but you can tell when price gets crazy and these warrants go into insane money, that does usually mark a peak in the equity as well. So, they squeeze up here, they squeeze up here. These are up significant gains, almost 1,000%. But then the stock kind of trades flat and goes down. Now, I don't think that's going to happen with GameStop, because GameStop, in my opinion, has extremely strong leadership that's going to find alternative revenue streams like power packs. Speaking of which, they just launched the lunar packs. I am astonished, by the way, it's a little tangential side note here, the amount of people putting money into lunar packs, the screenshots I've seen. These are $2,500 a pop, right? These are expensive to get. The fact of the matter is, a lot of people are doing it. What does that mean for the company? Revenue generation machine. So it's extremely exciting times for this company. We have Q3 earnings. We were on just about a week away from those. Another exciting moment for the company. But point being, I think it's a good note, not to get FOMO here, but the shorts that have shorted the stock into the ground with swaps, swap roll here, hedging synthetic shares and the warrants itself as a new product in that mix, you're going to see volatility up, you're going to see volatility down. How am I personally going to handle this? Well, it's at the point where I think, my personal thought is when GameStop is above $32 a share, look how rare that is, right? You have a couple candles here and here, right, over the last couple of years. Obviously, the Roaring Kitty stuff, let's just exclude that. But let's look at this span here. Extremely rare to be above 32, this line right here, right? Extremely rare. Now that you have the warrants in the mix, when GameStop gets above $32 a share, what are shorts going to want to do? Well, if they have any cash left in their account, they're probably going to want to exercise their warrants, gain access to the underlying stock, and then sell that stock on the open market, which will create another volatility feedback loop, probably a pullback in the share price before another upward assault. So I think we're going to see some zigzagging. Am I personally going to flip the warrants around? I'm not really sure. I mean, if they run 1,000%, I might trim some and then look to buy them back if they come down. But we'll see what the company does. I really feel like they're at the most interesting time that GameStop's ever been in is right now. And you could probably say that a lot over the past couple of years, especially when Roaring Kitty came back in 2024. But the financials and the fundamentals have been improved 10x better over that span. The last missing Tetris piece that Ryan Cohen, posted that little PFP on, that's more revenue. How are they going to get more revenue? While they're earning interest on their cash at 5%. That's good in a money market. They need another revenue stream. Power packs is one. That's a great start. If they add another one, that's when I think you're going to see the underlying, not the warrants. The warrants will be inherently valuable too, but the underlying put in a massive, massive move. Now, two other things about the warrants real quick. We need to understand they are not in ETFs. So there is no creation and redemption shenanigans with these warrants. They're not an XRT. You're not going to go into XRT and say, oh my gosh, I need access to the warrants to short them. You can't do it. You can't create and redeem these shares. That is one of the main issues in the stock market, not just with GameStop, but across these ETF products. In my opinion, the more I've been reading about them, the more I read about creation and redemption, it's very predatory on certain underlying stocks. GameStop happens to be the number one culprit of that, in my opinion. So they're not in ETFs. The third thing, T plus 33. If you're into the settlement logic, look at this date here, October 9. What happens? They short this thing into oblivion, insane high volume on the warrants. 33 trading days later, what happens? Okay, warrants start running up big time, right here, big time. It starts their Tuesday, it starts their big run up. Okay, is that a coincidence? I don't know. Okay, but it certainly lines up a lot. And the last thing I wanted to say, so you have, to recap, you have delta neutral strategies. You have shorts that have to have warrants accounted for, right? There's a finite supply of them. You're not going to rehypothecate these. The no ETFs is a major player. But the last thing I wanted to say too, and you probably have settlement rules working for these as well. When GameStop is above $32 a share, I don't think that means they're just going to dump the stock right then and there. But I would caution that that's probably a time where you're going to see bond desks, short traders, etc., try and pile in. It's at that moment where I think Ryan Cohen could deliver the coup de grace and send this thing into the stratosphere, meaning the underlying, if he acts in a way that will generate more revenue. Now, the other component there that everyone and their mother is talking about is Michael Burry, and the share buyback conversation has taken up like wildfire. It's going bananas. Now, Michael Burry, real quick, he did change his X header. It says, he put one of the articles in there. Michael Burry reportedly says Reddit favored meme stocks will crash as new money dries up. That's from 2021. Obviously that was his viewpoint then. He's obviously been talking about GME in a more favorable light lately. And we knew he established his position in 2019 in GameStop then, kicked off this whole crazy sequence that happened in January of 2021. A lot of that was because of Michael Burry. He deserves a lot of this credit. What's he saying here with this header? Well, GameStop's no longer a meme stock, so this doesn't apply to them, obviously, one. And then two, I think this might be his sort of reverse Uno card moment. And a lot of his Substack writings and comments with his new idea for the company, well, What if it involves a share buyback? I wanted to dissect that today. And there's an excellent Twitter post here from Simple Jack that essentially takes his formula, Michael Burry, the math in 2019. Here's a simple valuation. Fair multiple equals 1 divided by required return minus per share growth plus dilution minus buyback yield. Now, for all the non-savvy or non-fundamental people, is that there's a lot of them, me included, I'm still learning a ton. There, he goes on to explain that their stock-based compensation used to be 10 to 15% of its operating cash flow. That's way too high. That massive dilution, because that's giving shares to directors, 10 to 15% completely overwhelmed any modest required return, say 8 to 10%, and the negative per share growth from a declining business, right? So plugging in the numbers yielding a fair multiple of 14 to 16x, matching the stock's actual trading range to the decimal. Fast forward to now, when the business is a much better story, the Q2 10Q tells a radically different story. GameStop is now sitting on 8.7 in cash and cash equivalent securities, while SBC has collapsed to only 1.1% of cash flow from operations. That changes this entire narrative and redoes the calculation, which Burry laid out perfectly. So dilution drops from 12% to 1.1%. Required return remains 8 to 10%, and per share growth, this is extremely critical, turns positive at 10.9 to 16.9% simply from earning what? The 5% that I referenced earlier in the money market. That's from the cash yield alone. So now if you plug it in, the same Burry formula spits out fair multiples of 48x on the low and 110x on the high end. And you're probably saying, that is way too bullish on a brick and mortar retailer. That's just the formula. I always say, don't get mad at the numbers. That's the formula. That's not my words. That's the formula. So management uses a portion of this cash to repurchase shares at a conversion rate of 12% annual. Net dilution flips negative 10.9%. So the denominator in Burry's formula now approaches zero, and that fair value becomes infinite. Okay, so we're looking at something extremely interesting here. They say it's like Monster Beverage in the 2000s, where the market caps in those situations were 100 to 200x earnings until the buybacks are complete. Listen, this is all kind of hypothetical. If they were to do buybacks, this person is saying $41.76 would be the low on GME, which again, the warrants would be insanely valuable, with a high of $95 before the buybacks at its current forward PE of 26.20. $95, $41. I think anyone in these comments below, let me know your thoughts, would be loving that share price. Now, if they do buybacks, that would in theory be higher. What is the problem with the buybacks? There's two main things. And again, this is not bearish. This is just reality. One, they're only authorized, the board, Ryan Cohen, is only authorized to do $100 million of buybacks without further shareholder approval. So that would limit the amount that you can do anyway. The other point is GameStop's at $22.58. They were still approved to do buybacks all the way back here when GameStop was $10. Okay, when GameStop was $10. So they didn't do it there. Why would they do it here? It just doesn't make sense. I mean, the problem with it not making sense is that Ryan Cohen cannot initiate a short squeeze on purpose. What would be the communicated value of buying back shares at $22.52? Now, if the company had a different revenue stream already and they were comfortably over $1 billion every quarter and it was growing, maybe you could make that case. They're not doing that. They need to use that cash to generate more revenue for the business. So I would just caution the share buyback camp. Well, I personally would love it. I do not want to see the company get in any sort of legal headache situations where it becomes a problem. So is Burry's idea going to be a share buyback? Well, if the stock drops to $15, $16, I would be much more in favor of it. If it drops to $10, I say put the full 100 million in it, but not at this price. Let me know what you think in the comments below. I'd love to see a squeeze personally, but if I'm thinking more of a neutral party, I'm thinking of how does this company last decades and centuries, and it's to do things the right way. They've already made the business profitable. 5 quarters in a row. I'm beating that horse, right? They need to get their revenue higher. Point blank, period.